Like, perfect. I'd like to call the order the meeting of the pension board for February 12th and ask for approval of the minutes for the meeting of January 8th.
I'll make a motion to approve.
There's no question about the time.
No question about the time.
Mr. Baskin seconds.
All in favor?
Aye.
Aye. Is there any public comment? As usual, there's not. There's a single pension application. Do we have?
It's a very straightforward application, I think, so.
Yeah, I mean,
Fine for me
I
too.
looked it up.
I don't see any problem, but.
No. Is there a motion?
Charles Piro, I move to approve the application.
Is there a second?
Jim Henderson,
Second.
motion to approve, second.
All in favor?
Aye.
Aye.
Opposed? No. Passes unanimous. Perfect. So we're, DCW is gonna.
Yeah.
present now?
TCW Met West, they're gonna zoom in this evening. They are actually headquartered out in LA, so they were directly affected by the fires. I think in speaking with Mark Romano, who's been here in the past, he was saying their CEO and maybe a couple of other employees, were again impacted by it to a large extent. So we kind of offered up to them, given everything going on, the zoom in this time around, which they took us up on. Right, I think we told them 6 o'clock, right, that they would be at the top of the meeting.
Yeah, I confirmed earlier today. I just shot them a note.
Okay,
Not sure why they're not on yet.
yeah, we can give them a second, but we do have one of their 3 generalist PMs joining us. I think last time around we had the CIO. And this time we have one of the other PMs, Jerry Cudzo, who's gonna speak to the board about performance. I don't know if there's anything else you wanna jump to in the meantime, but we can give them a couple minutes if you'd like.
We'll just give a couple minutes and we'll go on to the experience.
Okay.
But I'm not really sure.
We can try.
I could promote them to panelists to see if that's them.
Sure.
It's a 2 or 3 number.
Oh, this one's Tina.
Yeah, okay.
Elizabeth.
Yeah, I bet the one room.
Oh, there it
Yeah,
is.
there
So
we
it
go.
is them.
Right.
Perfect.
Okay.
Okay, yeah.
Okay.
Okay, there we go.
Good.
We're good.
Can you hear us?
Yeah, is that Mark, Gary?
Yeah,
Okay.
so Mark McNeil, and
Jerry
Jerry Cudzo from the US Fixed Income team. Sorry about the technical difficulty there, but happy to join you this evening. Provide a quick update on the firm and then turn it over to Jerry to walk through the team, our investment process, philosophy, and talk about the portfolio and any other questions that you may all have. Please feel free to interrupt, ask questions along the way. I'd like to keep this as interactive as possible. But just for a quick update on the firm.
I'm just gonna cut you off for one quick sec for, it's behind the first tab in the book, the presentation. So if anybody needs a hard copy, I have some down here. Yeah. Yeah, absolutely.
I'm on, just for reference, I'm on page 5 of the materials, just a snapshot of assets under management for the firm. We finished the year roughly at about 195 billion in total firm assets. You can see fixed income continues to be the lion's share of firm assets, 173 billion. The strategy you're invested in, our Core Plus strategy, again, the bulk of our overall fixed income assets. No other changes as it relates to the firm. Our ownership continues to be the same, very stable. A few initiatives over the past year with our new CEO joining as we look to grow the firm, focus on specific areas of growth, but in general, everything now very status quo at the firm. Just moving ahead so we can get to Jerry, I'm going to land on page 6, the org chart, just as a reminder of the team that does manage the strategy that you're invested in. Again, team-based approach. You see Jerry Kudzel, one of our 3 generalist portfolio managers, works alongside Brian Whalen and Ruben Evsinian, managing all our U.S. fixed income portfolios with the team you see down below. So without further ado, I'll let Jerry take over from here and really provide an update on anything else on the team that you want to highlight, and then get into the bulk of the rest of the presentation.
Great. Yeah, maybe what I'll highlight is just one thing. Anybody on the top senior portfolio manager and above is part of what we call our fixed income investment committee. So we have a team now, 18 or so individuals, and they're the senior portfolio managers, the specialist portfolio managers, and the generalists. It comes from our corporate credit team, our securitized team, our emerging markets team, our rates team, and that's global. And so we have that meeting. Every week. It's Tuesday, 8 a.m. We all huddle up, and that's around the globe. And it really just to share ideas, help kind of shape our views, bring up any kind of risks, concerns, or highlight opportunities. In this meeting we had yesterday, we just went through and shared, what opportunities that we're seeing based on what's developed in the marketplace in the kind of first month of the year. So we kind of went around and did an ideas meeting yesterday for the first hour or so, which was really really helpful. So that's the one thing I'd highlight. It's there's no voting in that committee. It's a collaborative process. It's a sharing of ideas, really meant to bring the teams together, make sure everyone is communicating. We're all hearing each other's ideas. This way, when a securitized member has an idea, corporate credit can push back on it, and similarly, when a person in London has an idea, we're doing euro credit versus U.S. dollar credit. Well, those opportunities can be kicked around real time and then taken offline. But real collaborative experience that takes place. That happens on a weekly basis. There's some obviously regular meetings and daily dialogue, but just so you have a sense of how the process works. On page, maybe what I'll do is I'll flip to page 9, and I don't want to spend an inordinate amount of time, but what I would say is on our philosophy, if we were, we always say, give us the quick elevator pitch. If we had to walk away, the call got cut off, and there are 3 things that we need to take away from this phone call. It's a team-based approach here at TCW, so you won't see, you won't see names we have 3 to 5 portfolio managers on every fund. Generalist portfolio managers are involved in every decision. We lean on our teams. They're really deep and credible, so we hire really smart, experienced people. We don't hire them to turn their brains off. I mean, it really is a team-based approach. We believe teams outperform individuals. That's first. Second is it's a value process. So when, what does that mean? We'll get into that a little bit later. We'll show you positioning. It kind of flows out of that. It's a fundamental organic bottoms-up approach to investing. That's critical as you think about the way we populate portfolios. It really is. It's an organic process. There's a macro overlay that's just to recognize our full cycle view. But we think what's repeatable over time is issue selection, sector selection. This organic bottoms up approach we think is repeatable. And the third thing is this dynamic allocation of risk. We allocate the portfolios dynamically throughout the business cycle. We have opinions and based on what we're seeing, both on pricing in the marketplace and what we think about prospective returns, we're dynamically allocating the portfolio real times. So it's teams outperform individuals clearly. So we're team-based, consensus-driven process. It's fundamental value, and it's a dynamic approach to risk. That's if we had to sum up our process and our philosophy. That's the key. Those are the kind of key tenets and the cornerstones of what we do.
I have a question. When you're talking about risk, didn't you extend out your maturities?
So that's a good question. What I'll do is I'll flip to once you flip to page 15, actually, why don't we go to 11? So what we did as part of the allocation, so over the last few years as interest rates were rising, this is what we've done in terms of the duration in the Core Plus portfolio. We tend to we take a dollar cost averaging approach as part of our kind of value approach or value philosophy and process. So we dollar cost average into and dollar cost average out of risk. And in this chart, this is a simple chart. We have a little bit more of a complex one, tells another layer of the story, but this is just plots the 10-year yield, which is kind of this orange on the right-hand side, versus our duration positioning on the left-hand side. And what you'll see is that we've extended duration as interest rates rose in the marketplace, and we've maintained a kind of healthy overweight to duration, just given the fact that yields, in our opinion, remain high. Fed funds, in our opinion, remains kind of above a neutral rate in restrictive territory, and real rates, which is your nominal yield minus inflation, in our opinion, remain attractive. And so the inputs into that are, why do we think it's attractive to kind of add that yield into the portfolio, that incremental duration? Why are we comfortable doing that? And the backup in yields associated with a normalization in inflation, which means that the nominal yield less that inflation, that real yield is, in our opinion, remains elevated. So that's why we've extended out that duration. What you don't see here is how we're taking that exposure. And the one caveat we would say is we're less constructive just on kind of longer end duration. So if you think about 10-year and 30-year maturities, we would say we're less constructive there. We're more constructive on the kind of belly of the curve. We think there's stability to be had. We think front end rates are anchored. Our opinion about Federal Reserve policy is that, yes, the Fed remains in restrictive territory, and the bar is very high, in our opinion, for the Fed to come in and raise rates. Whether or not they're on hold, this hurry up and wait scenario we kind of find ourselves in now with, the last mile of inflation may be a little bit harder to achieve. Our opinion is that this will be the ballast in the portfolio. We like having exposure to kind of the belly of the interest rate curve. So yes, we have extended the duration in the portfolio. This is interest rate duration, and really it's in the belly is the majority of that exposure, which is focused on 2-year and 5-year.
I have a
I
question.
thought you were more 5 and 7, not 2 to 5.
Well, the bucketing that we do, our 5-year exposure actually is our key rates are going to be 6-month, 2-year, 5-year, 10-year, 20-year, 30-year. Our 5-year bucket will capture some 7-year. Our 10-year bucket will capture some 7-year, but the majority of our exposure will be 2s and 5s. If we were to give you the bucketing and the breakdown, it'll be about 80% of it will be in the front end of this 2s and 5s.
But buying the 10-year was a mistake, wasn't it? That was a bad decision. I mean, the 10 years gone down in price, up in yield since the Fed started cutting rates.
We haven't extended duration significantly more since the Fed has begun cutting. We've kind of maintained our long duration position. I think part of what we did when we dollar cost average in is our view is that it gets attractive. Prices may become more attractive. We may get to a point where we may be the definitionally, our approach from a value perspective as we dollar cost average in means that at some point, some of the purchases will look like they were bad purchases. But we think over time, the way that we approach and the way that we enter and exit produces a smoother, repeatable, understandable process. And that's why we take the approach we do, and we implement the strategies that we implement.
Gary, maybe if I can sort of ask the same question, but maybe another way. The 3-year number is underwater now, and it looks like the overweight to duration started around 3 years ago. So
Yep.
how much of that duration overweight is attributable to the underperformance? And if that's the case, why continue to try to, fight the Fed, for lack of a better term, or interpret what they're gonna do? And why not take a more neutral stance?
Well, I remember from the last presentation you were in, you were very, very adamant about Fed raising has never not led to a recession. And that you thought the odds of a soft landing was extremely small and very remote. And it's never happened before, so you didn't expect to happen again. Now so that scenario didn't work out. So what's the motivation for the long duration now? If the motivation and the story for having that long duration bet that's passed, are you changing your thesis now to justify the long duration bet?
Yeah, I think these are these are all great questions. These are questions that we ask ourselves every day, to be honest. And I'd say the short answer in terms of
I want the complete answer. I don't care whether it's long or short. I just want the complete answer.
well,
Okay.
We'll give you the complete answer.
Thank you.
You're welcome. As you think about, as we digest, okay, when we dollar cost average into duration and our call about a recession, the Fed raising rates as quickly as they did, and how we thought that would lead to a significant slowdown as interest rates bite, and we talked about long and variable lags, and we thought there would be a recession. Our view was that those interest rates would bite, and at the end of the day, it would change consumer behavior. Ultimately, that didn't happen. I think there's two pieces.
So what's your new thesis for being long duration?
Well, our thesis is that
I'm not attacking that. You made a decision. The outcome is different than the decision. What's leading to the decision now to stay long duration? That's what I'm trying to get at.
Yeah, we think that inflation is coming down, in our opinion. So our opinion is that inflation is going to be normalizing. As rents roll over, as some of the policy implementation kind of takes hold, our opinion is that we're at a point now where you've priced in our opinion, all of that information is already into the marketplace. So when we say why do we have the position we do, we always try to take the new information and say, are we being properly compensated to take the risk that we're taking? And
that's good.
And today we would answer that question and say, yes, we are being properly compensated to take that risk. We believe that the factors of inflation are coming our way. We believe that, or actually not coming our way, are moving in the direction that are becoming more sanguine. And that's informed a lot by owner's equivalent rent. It's informed by what we see as a kind of full labor market. But as you take a look at the labor market and you look at job openings coming down and you look at the quits rate coming down, our opinion is that yes, the employment market remains full, but it also remains vulnerable.
You know,
So
can
you're-
can I just ask, mention something? Excuse me, but, you know, the way you're talking, you must have not looked at the CPI that came out today.
3.3.
Right, so you're wrong.
Well, we're yet to be seen.
Yeah,
Well-
I think,
Well, he's talking about the,
So my question would be, for your duration bet to work now, do you
Mhm.
need inflation to come down by 100 basis points, and by when? Or is it 150, or is it just 50 in 18 months, 2 years? Give me some kind of a timeframe and target and timeframe if you don't mind, and
yeah, we don't think that, I'd say a couple things. We don't predict, although we think directionally inflation is coming down, and we do believe that inflation will hit the target. Whether that takes 6 months, 12 months, or 18 months, I think the answer is we probably think it takes probably about 6 to 12 months. It does feel like obviously it's stickier than we would have thought for sure. But when you think about when we think about pricing in one Fed cut for the rest of this year, and almost a neutral rate as priced into the marketplace today, which is only another 50 basis points of cuts. Well, in our opinion is that can change very quickly. A lot of things can change the direction of interest rates. Yes, it's inflation coming down. There's also other components. We believe inflation is coming down, and that will be a tailwind for our duration position. And we think you're supposed to, when you're constructive on the real rate, which is your inflation rate, your nominal rate minus your inflation rate, we believe you're supposed to carry a long duration position in those scenarios. But we also have a backdrop in our opinion, where our base case is, remains that the economy is not as strong as it appears on the surface, but that these tails have gotten fatter, meaning that the volatility associated with the implementation of policy or geopolitics or other things have increased in a pretty dramatic way. And that goes for a recognition that we can see a real slip on the implementation on a growth scare or input. And I think that we're recognizing that kind of move lower in interest rates associated with a real policy slip up is significant. I think on the other side, what we also recognize is the policies that are being pursued are potentially, whether it's immigration or deregulation, they're pro-growth in some scenario, or potentially inflationary if you consider that. And there could certainly be a scenario where it's not our base case, but it could be a scenario where there's a scare and a reflation. I don't think today's CPI print, in our opinion, doesn't tell us that inflation is necessarily reaccelerating. Some of the things that are coming through, whether that's egg prices due to an avian flu or insurance prices, some of that insurance is more of a tax, in our opinion, not necessarily doesn't necessarily feed through in inflation. Of course, it costs people more money, but that's not. So my point about this is that does exist. We've done a few things to try to recognize that, not sit still in this scenario. But the base case, in our opinion, remains, that you're supposed to own duration for that reason. And if you believe that interest rates the real rate is high enough and you're being compensated, you're in an environment where some of these policies that are being put forward, and you're hearing from national economic advisors talking about 10-year rates moving lower, not because of a single flip of a switch. This isn't a Fed saying we're going to raise rates or lower rates. They're talking about an implementation of macro policy that they think will move rates lower. And I think there's a different mindset than there is necessarily at the Federal Reserve. And I think that's something else to kind of to take some comfort in a long duration position. So I'd say last year, what did we miss? Or what was when you think about duration and the implementation in 22, what did we miss? Why did rates stay high? Why did we not have a recession? To look at deficits spending as significant as they were through 2023-24, and the resiliency of the consumer because of the COVID money that was remained, I think we definitely underestimated the resiliency of the consumer and underestimated the power of budget deficits and what that would mean for the macro backdrop. Our opinion today is that the normalization of interest rates doesn't necessarily hinge upon the economy going into recession, although that would be helpful. But a normalization of inflation, in our opinion, would be and is our base case as it relates to the positioning.
When you say normalization of inflation, does that mean 2%?
Yes.
Okay.
Just one question, you touched on it briefly, but when I think of the new administration and tariffs, tariffs mean inflation. And while growth and the labor market certainly contribute to that, how are you thinking about tariffs and their implications in terms of potential jumps in inflation in certainly the near and intermediate term?
Yeah, I think there's a lot of this is probably a longer call, but there's a lot of debate around the tariffs, the way that the tariffs have been implemented. We did already see prior to the end of last year, almost 7% move higher in the dollar to reflect the idea that there was a thought or a fear around kind of a broad-based tariff implementation, and that maybe 10% with trading partners, 60% with China. And I think what we have observed is maybe a little bit more of a bilateral approach and a little bit more of a retaliatory approach, which is kind of use tariffs as a negotiating tool. In our opinion, that's more constructive because it's more limiting in the way that these tariffs will essentially be used. I think you have to assume, our opinion is, the government is this government's going to need revenue. We have to assume some minimum level of tariffs. But we have also on the other side already seen a response from our trading partners, which we think is positive, which is why we think the tariffs are maybe a little more complicated than just looking at the tariff side of the equation, because as tariffs get implemented or the threat of tariffs get implemented, the EU signs an LNG deal. And as tariffs get threatened or implemented with Mexico or Canada, which, by the way, took us by surprise, apparently took his advisors by surprise, certainly the Mexico and Canada tariffs. Well, then you have 10,000 troops on the border in Mexico, and you get a response from Canada as well in terms of the support security. So they get delayed.
I don't mean to interrupt, but you've been talking for a long time. So I just want to ask a question too. So the last 12 months, your return was less than 1%. Why should we keep money with you when we could go buy the 10-year? You like duration. Today they did $39 billion worth of the 10-year, right?
Yep.
The auction. The yield at 4 o'clock was 4.64%. Why don't we just take 4.64%? We have $50 million with you. 4.5% is certainly a lot better than 90 basis points, or even over the last, say, 3 years was like, a negative number. Why not just do that and say, okay, we're gonna buy these things, we'll put them in the bank, yield to maturity, whether the bonds go up or down, we're gonna be getting 4.60 a year. Why not do that? No pay, and we don't have to pay any fees.
Yep. If you go to page 15, maybe I'll just talk a little bit about positioning. It's a good segue into what are we doing with the money? How are we setting up the portfolio? Because the short answer is obviously, we're active managers. We should be over time, over a full cycle beating a benchmark. That is what and how are we positioning to do that? I think our thought is, if you take a look at the portfolio today, we're out yielding the index. So your portfolio today is is roughly, roughly yielding, low 5%. So it's, obviously it's a pick to the index itself. Obviously it's higher than the 10-year rate. The duration itself is long. It's going to be about 0.7 of a year long, that of the index. And then, so below the surface, though, what else are we doing, and why would you want exposure? Our goal is to beat the Bloomberg's Barclays aggregate. We're being comped to the aggregate index, and our goal is to beat that index by 100 basis points over a full cycle. That's what we're tasked to do. And how are we doing that? I'll say today, we're pulling on a few main levers. I'll just highlight real quick. One is the duration positioning, which we've talked about a lot here. The second is credit. We have some exposure to investment grade credit, very little to high yield, but have a very significant underweight to corporate credit relative to this benchmark, and that in our opinion represents the little bit of value or the lack of value in the corporate credit market today. We do have an overweight toward agency and non-agency mortgages in the portfolio. Again, agency mortgages, in our opinion, look really attractive nominally and look really attractive relative to corporate bonds. We think that'll be additive to total returns. And we've also found opportunity both in commercial mortgage backs, so CMBS bonds, and then asset-backed securities as well. The main part of our asset backs are in what's called CLOs, the highest quality CLO tranches. So we believe this composition in the portfolio will enable two things. One, enable us to out carry. Two, we are, our teams are looking every day at optimizing and finding value below the surface. And then three, enable us to dynamically allocate. So that last piece that we talked about in terms of the philosophy and the approach, dynamically allocate the portfolio and take this underweight to corporate credit, this overweight to mortgages, and upon volatility, upon better relative value, kind of move it into corporate credit. The last piece is on page 29. Is
Before you go there, could I ask a question about the mortgage backs?
Sure.
So you're like 50% almost in mortgage backs, and 12% versus zero for the Bloomberg on the non-agencies. Particularly on the non-agencies, do you see any, maybe it's insignificant in the scheme of things, but hurricanes and wildfires increasing defaults, and is there any concern there, or is it just not enough to move the needle?
No, we haven't seen. There's no concern. The short answer is, unfortunately, I lost my home in the wildfire, but I can kind of speak to this directly. But when what you will see is if there is a wildfire and a home is destroyed and there are insurance proceeds that are realized, there's equity value in these homes upon this pay down. So to the extent that there's a non-qualifying mortgage against one of these homes that a bank is holding, well, if there are insurance proceeds that are received, you can pay it down. And if in fact that person were to walk away, well, ultimately any insurance proceeds go to the bank first, and then the bank would own the land, and the LTV protects us to such an extent. There's the credit enhancement in these non-agency give us enough cushion where we're not going to take. There's no dollars of loss to be realized, especially where we are. Our average credit enhancement in our holdings is about 30%, between 25 and 30% across the portfolio. So you're really not going to experience loss even in a situation like that.
Jerry, thinking about slide 13, right? Like the majority of the portfolio should be driven by security selection and sector allocation, 75-90%. But in reality, I'm wondering, when taking a look at the attribution, how much is attributable to those two versus that duration that we talked about earlier?
Yeah, that was a question where I was going to go too, and
Yep.
this is a historical historical chart, do you have it year by year? You know, what are we, to extend the question is, you know, what are we pay? Where
Like if 10%.
You obviously, the hit you took on duration was greater than all the other alpha generated by the rest of the book. And traditionally, you say that the duration and yield curve's only 5 to 15% of the alpha, yet it's eaten all the other alpha for lunch the last 2 or 3 years. And so, you know, what we want, what I would like to see is, and perhaps, you can follow up with Callan on this, is a year by year sources of alpha chart. So we can, you said that 2009, 2010 was a big yield curve year two. All right, is that, does it ever recover? Or how much do you have to out earn in your other sources of alpha historically to recover what was lost in the yield curve bet? Yeah, because the yield curve bet isn't changing.
Yeah, we can follow up with the exact numerical attribution, but if we break down sort of the past 3 years, we look at 2022. Yes, our duration positioning as we extended duration in 2022 definitely hurt the portfolio from an attribution perspective. But when we get into 2023, we see the exact opposite, where for the entire calendar year of 2023, remember, we saw rates rally significantly in the fourth quarter of 2023. The bond market was up about 7% in the fourth quarter of 2023. And our duration positioning was positive there. So when you take those 2 years, they somewhat offset each other. Where
But
duration,
then you underperform the index then.
we underperformed.
So your duration bet bailed you out, but then you underperform the index. So that would mean your sector allocation and security selection didn't do was the anchor. I mean, this is why I want to see that, because the numbers don't seem to be adding up for me.
Yeah, we'll follow up with the exact numerical attribution, but I was just talking more bigger picture because we have seen positive security selection.
Yeah, well, we have all the data.
Yeah.
It's easy.
Okay, good, thanks.
Yeah,
Jared, more importantly, I just think why take such a hit from the duration piece when it's such a small portion of the portfolio? Like, why not put all the emphasis in where you think you have skill, which is in the security and sector part of it, versus the duration, which is it's a gamble, right? Like, so why have
Much
that
more of a
outlay?
macro call.
It's much more of a macro call, which, any one number of things can go against you. So if you have the skill set in the other areas where you've got 75-90% of the emphasis anyway in terms of alpha drivers, why gamble, so much on the other 5 or 10%?
Yeah, you don't need 600 people to make a macro bet.
Yeah, this is true, and we have very experienced teams in credit and securitized, as you guys have alluded to, which we're proud of and lean on for all the time. I think what we generally think about, and I think what happened in 2022, the magnitude of the rate rise, what it does is it overemphasizes, obviously, or kind of shows a very high expression of a macro attribution. Obviously, I mean, that's not a profound statement, but it is going to make it. It definitionally it obviously impacted returns in a big way. And so the right question is to say, okay, well, if it's the volatility of returns was increased in such a dramatic way, that risk budget should have been smaller in that macro piece. I think, we have a plus minus a year in duration, and the reason we have that plus minus a year, and the reason it foots into this kind of this 5 to 15%, this macro piece is a small component, was because that volatility in the past has been significantly lower over time. If we think about kind of the move index as a measurement of the volatility in interest rates. And so just historically, as we think about allocation of a risk budget, and I think we feel like we're in a, we feel like we're in a more normal in a more normal environment for volatility. And what we've done though also at the same time is, as I referenced, kind of recognized a little bit of a fatter tail. And so what we have taken the reins in a little bit, just in terms of buying tips, in terms moving nominals to tips, and then also hedging against a little bit of a hedge against the rise in rates with a pay or swaption as well. So we've done a couple of things on the to recognize that the tails are fatter, but also think that we're in a more normal environment. And we should be in an environment where rates are not going to go up another 500 basis points. That's kind of not that's not a normal move in interest rates, nor do we expect that anything like that experience again. And so what did overwhelm and clearly prove to be a significant headwind will be obviously significantly smaller. If it's a headwind at all, will be significantly smaller on a go-forward basis. Just because of the starting point.
Are you making smaller duration bets now than you were obviously in the last couple of years, but longer term, were you in the making duration bets on a regular basis, or did you just kind of get caught at a bad time? And
I don't think the way we think about duration just generally, and I think that's why we have the chart here on page 11. It's not really a bet per se. We don't come in and kind of have an epiphany. We do kind of try to dollar cost average in, dollar cost average out, just kind of like we do everything, kind of in all of the kind of risk budgets and levers and the buckets that we're using. And so as there should be a decent fit to the move in interest rates and real nominal rates here, but real rates as well, and our overweight and underweight to duration positioning. So I think what we did see was a significant move from basically off of zero interest rates, and a significant move higher, which is why you did see the increase in 22 was steeper than it's been in the past, just like the reduction back in 2019 was steeper because of the move lower in yield. So we try to always, if you look at historically positioning, whether it's in duration here or credit, or any sector, we try to have we try to gravitate toward dislocation and volatility, and then on page 12, and then allocate to those places in a fairly significant way, and be active and make sure we're using those risk budgets to try to take advantage and try to make sure that we're able to perform over the full cycle. So our process is one that we don't, I know you said bet, I know you didn't mean it that way. We think of it as, kind of allocations, dollar cost averaging in over the long term. And this is, some of what we've done in sectors comes through here. This page on 12, the stand chart on 12 is kind of the change in the sector allocation over the cycle, which is representative of where we think the value is.
But when you dollar cost average in, what's the time frame for that? Is that over a couple months, over 6 months, a year?
It's really a function of we do two things. We kind of think through what a full position would be. So for duration, it's plus or minus a year. Same thing for credit, plus or minus a year of spread duration. So what we'll do is we'll think about how many, where are we relative to where we think kind of value is. Real rates, what we would say is on real rates outside of 2% are attractive. So we're probably going to be close to our full risk budget when real rates are kind of 2%ish. Investment grade credit, what we would say is we have frameworks built to where we begin to kind of remove underweights. We're going to be extremely overweight at 200 investment grade credit. We're going to begin to remove underweights around 120. 150 is the average level around a recession in investment grade credit. So we're going to be overweight, but we're going to have more room in our risk budget to continue to add as spreads move wider. So really it's not really a function of time as much as it is a function of kind of prospective returns and the level which implies a prospective return, if that answers your question.
I have another question. What, the quality composition, the fact that you have triple C and below of 5.5%.
Yeah.
I mean, like, you have single Bs, double Bs, none of those are the Bloomberg aggregate bond index. What is your parameters? How much could you put in triple C bonds? Do you have a limit? I mean, could you put 10% in?
We do. Just to be clear, if you look on the left-hand side, so what's being captured on this triple C component, triple C and below, is non-agency exposure, which essentially is legacy non-agency exposure. What we have, our exposure is at this point burned out and it has actually significant HPA and credit enhancement. So we view those as investment grade. They just won't get re-rated by agencies because it's just a structural rating. But if the better way to think about our high yield exposure today is this on the left-hand side, this 2.55%. What's being captured in this triple C and below, and probably some of the double B and single B, because in the high yield credit, that's really stripping out high yield corporate credit. That's going to be our bank loan and our high yield bond exposure. That is our below high yield exposure. And today we're using a small portion of that. We have a 0 to 20% bucket in the core plus to below investment grade. And today we're using 2.5% of that limit in the high yield exposure.
So you could have 20% in high yield?
We do have the bucket to go to.
Question. Is that, maybe I misunderstood you. You could have 20% in high yield?
Yeah, yes, that's the other bucket. That's the plus. That's the plus. The 0 to 20 is the plus. We've historically not used the 20% number as we've added to credit and dislocations. In 2020, I think the number got to high single digits. That was a function of some of the fallen angels that we had owned at the time. Ford got downgraded, Kraft Heinz got downgraded, Occidental Petroleum got downgraded. So some of those names got downgraded, which we continued to hold through that. And then all of those subsequently were upgraded back to investment grade. But today that number sits at 2.5%.
I would say that that's actually pretty standard for core plus strategies too. That range within manager guidelines. So
It's a little more risk to them than there is to, say, 10-year treasuries that we could buy. Another thought.
Yeah, the plus should be an enhancement, obviously, to the core strategy, to the ag, to the index, and that over time we do believe it's it will be yield enhancing, given the levels of where, in our opinion, where high yield trades today. So high yield levels are around 270, 260 basis points. Historically, that's really little. That's spread premium is small compared to where it can go historically. So we're using a small portion of that risk budget today.
Any other questions?
Mhm.
Thank you very much for your time.
Very
Great.
informative. Thank you.
Thank you.
All right, thank you very much. Thank you. Bye.
So later we're gonna go to executive session for other things, so we can maybe have a follow-up conversation about this.
Good.
Yeah.
And I loved your questions, by the way. You were better than me.
You guys, we're definitely experts today. I was impressed. I learned a lot just listening to you guys.
Okay. We're gonna review the pension experience study.
Can I sit up here? Yeah.
Sure.
Okay, all right. Should somebody?
You can even move in if you want.
No, I don't want to be at the head of the table.
Just don't talk about the foot at the table.
Just don't tell us that we're asking the wrong question.
I got a conversation, I got a conversation about inflation, I'm a little scared to talk about
I
it.
mean, you know, really funny, it's like, the CPI's, like you said.
Well,
No,
Three today. right?
it was
Can you
the
forward the presentation to
the
David
attitude
and
more than
Eileen?
anything.
Oh, sure.
You're
Just so they
asking
have
the
it.
wrong question.
Ben just sent you an
Not the
email.
way to phrase it.
Right, because that's a question I don't want to have to answer.
Well, it's more like another way of thinking of it is,
Yeah.
rather than.
You can send it to the whole board.
Yeah, I'll send it to everybody.
So, David and Eileen, for you guys that are not here, Chitsumate's sending you an email right now with a copy of the presentation that we'll go through, so you can kind of follow along.
Thank you.
Okay,
Great. So we've got a report for you and a presentation. I'm gonna go through the presentation, just a kind of summary of the report. So what is an experience study? In case you don't know, but it's basically all of the assumptions that go into the valuation reports. They're usually listed in the back of the valuation reports, but every single assumption that goes into it, we review. And we typically do these on a 5-year basis. We're talking investment return, inflation, but then also where the actuaries get nerded out is the demographics. When are people retiring, withdrawing pay scale, pay increases that occur, and mortality. We wouldn't be actuaries if we didn't have a conversation about mortality here. So, the report is for a 4-year period. And it's a little bit delayed, and we apologize for that. We were hoping to include the 2024 census data as well included in this to get another year post pandemic. But, you know, we weren't able to get the 2024 census data completed in time for this study. So we're here for a 4-year period, which still has great information. Slide 2, just talk about us a little bit. This is our team, me and Ben, who works a lot with Jared and Chitsame and others on staff. But we're now CavMac. I don't know if we rebranded this past year. We were Cavanaugh McDonald Consulting, and we just shortened the name. Everybody just called us CavMac anyway, so we decided just to go with that. And there's the rest of our team, Darby, James, and Zach, which again, a lot of the, what's that?
It's like Duncan.
Exactly, right. No more Dunkin' Donuts. Yeah, exactly, right. So, but we're still the same actuarial firm that we've been. We're gonna talk about the purpose of the experience study and go through the findings, and then, of course, you all want to see the cost impact of these changes. So slide 4, just talk a little bit about our actuarial model. You know, you all see the end product, the reports, the presentations, the projections, and know what the unfunded accrued liabilities are and the funded ratios of each of these 5 plans. But what goes into it is so instrumental. The data that we collect, and then the actual assumptions and methods that we use, that's all kind of being done behind the scenes by us and in our models to come up with all of these outputs that you see.
Do you do that data collection annually? Or
We do.
Periodic, yeah, okay.
Yeah, we do. We ask staff to send us the data in July for the June 30th, as of June 30th of every year.
Okay.
So on slide 5, just the purpose of an experience study, again, as I mentioned up front, to review and evaluate all those actuarial assumptions and methods that go into it. Again, generally performed every 5 years for the city. We have strict guidelines that you know, that we're have to oblige by, and they're called actuarial standards of practice. So they kind of give us guidance on how to come up with new assumptions and propose new assumptions for folks. There's no right answer. There's a lot of professional judgment. It's funny because this field is called actuarial science, and there's no science really behind setting assumptions sometimes. It's kind of a feel. And we're in this We do over 75 plans, public sector pension plans across the country. So we have a lot of background on setting assumptions, especially demographic assumptions. On slide 6, I'm gonna spend a little time talking about the actuarial methods. Especially the unfunded accrued liability amortization policy, because we're recommending a change to the board and kind of want to have a conversation with this board about this. The first 2 items, entry age normal cost method and 5-year smoothing on the assets. That's done by 93% of public sector plans across the country. You guys use
What
it.
do the other 7% do?
It's the other 7 use projected unit credit, which is more on a cost method basis, which is more, it's based on, the cost is higher when you're closer to retirement. Entry age normal spreads the cost out over time, from your entry age to your retirement date. So it's used by all these pension plans for budgetary reasons because it's more stable. Projected unit credit is not as stable, especially for the
Would it make a-
closed plans,
Yeah, okay.
for
So
your
for a
older
For a
population.
closed plan, the entry age normal is, entry age has more to do with retirement. When people are retirement than versus when the idea of entering the
Yeah.
pension program.
So for example, I like to say this is you have a 40-year-old in the plan. They were hired at 25, so they've got 15 years and they're gonna retire in 15 years from there, right? They've already accrued 15 years, right? And we're expecting them to accrue another 15 years of service. But that accrual in the back end is worth so much more, right?
Oh, yeah.
Because your pay is so much more.
Mhm.
That's your benefit accrual. The entry age spreads that cost of what we're expecting your benefit to be back to when you were 25. And it just provides for more stable, less volatile budgetary numbers. And we'll get into it when we talk about normal
Okay,
costs.
thanks.
But the big thing that I want to talk to you about is the amortization basis. If you know from the valuations, we're using a closed amortization basis. So the unfunded actuarial accrued liability is amortized over, right now, we're at 13 years as of the last, the 2023 valuations. So in 13 years, if you continue to pay the actually determined contribution, all of your plans should be 100% funded. But what we've been seeing, and you've probably noticed, and I've noticed it, I'm sure Jared's noticed it, is the costs that we're providing to you has been going up significantly. The contributions that we're requiring or recommending be put in are going up over the past few years because that period is dropping so drastically. And it's getting close to under 10 years now. And when you have a big gain, or I should say a big loss, like we've seen over the past few years, we're spreading that over such a small period of time now, 13 years. So just think about your mortgage. When you had a 30-year mortgage, right, your payment was a lot less. But if you re-amortized over a 10-year or 12-year mortgage, you're gonna pay a lot more. Well, that's what the plans have been experiencing, and that's why when we have a $3 million hit each year to each of these pension plans, because we've been reducing the discount rate, the investment return, down to 6.5% in all these increments, we're amortizing that, and it's pretty costly. And so that's why you're seeing pretty significant increases in your recommended contributions. So what
Do you have a table or anything that shows that? Because remember from the annual reports, you break it out by how much was due to the discount factor, how much was that and that and that. We're no longer reducing the discount factor. Why shouldn't that level off and cause less of an increase going forward?
Yes.
The rest of the 13 years?
I completely agree with you. You're exactly right. We've gotten down there. However, what if another 2008, 2009 Great Recession hits on an investment basis? when the amortization period is at 5 years. Now you've just lost 25%. Hopefully this will never happen. But you've just lost 25%. You've got to recognize that and pay for it over a 5-year period.
Or we could change the plan then.
You could change the plan.
Right.
Yes.
So then, but
Yeah.
the thing is that it's been changed in the past. When Tom Hamilton was here, he changed it when we started, I don't know, were you here with Tom?
Change the methodology.
No, what he did was he changed the assumptions and he kept bumping it back every time we reduced the.
I-
Every
Yeah, that's-
time we reduced our bogey,
Mhm.
he just kept extending out,
Yeah.
you know.
Now, that's
And-
not
and
what
look,
I'm
can I finish?
recommending.
No,
Yeah.
so then, but Henry, when I talked to him about it even and said, well, you know, when we're going down here, he said, no, I don't wanna do that. He
Yeah.
said, and I agreed with him, he said, he felt like that was a gimmick. Do you know what I mean?
Yeah.
Like,
Take your medicine.
take them,
Yeah,
right,
right.
so we were,
Yeah,
that's why.
and that's
we're
why Henry, believe me, I've had many
You dealt with-
conversations with him about this.
Right,
And he said, no, I wanna keep reducing it.
right,
And that's not what I'm recommending. What I'm recommending is any new gains and losses that occur, they get spread over their own closed amortization period. Okay, so if you have a period like 2008 and 2009, or you give huge salary increases and we have a huge payroll loss, you spread that over its own period. The current unfunded, let's keep it on its path. 13 years, let's pay that off. But any new basis we set over a 10-year or 15-year period over its own closed basis, because it helps with the volatility that comes in the contribution requirement.
I'm gonna have to see some numbers.
So I got an example.
Well,
Oh, well, let's go, you wanna go through an example?
Well, I'm gonna need to see real numbers.
Well, all right, so these are not real numbers, but this is kind of, what we kind of show you is this example on slides, 8, 9, and 10. Is if you bought a house.
Excuse me, interrupted. We didn't get the presentation yet. I'm not sure whether Chitsme has sent it or not, but we've not gotten it yet. Are we getting it now? Is that the plan?
It was sent. Let me just check.
I didn't get it.
Yeah,
Yeah.
I'm sorry.
Oh, no, that's okay. Let me go connect.
Jared, I sent it to Jared as well.
I can do it.
Can you?
Yeah.
while they're looking to do that, one of the things, I do think what you're saying, for example, like large pay increases, if there were large pay increases, it's really not gonna affect part of the pension plan in the sense that it could affect police and fire, that section. And I could see where you want to amortize them a little differently.
Yes.
Because really the number of people in the city now, it's probably only a few hundred that are still in the pension.
Right,
plan.
I'm not even suggesting this for city.
And the
Yeah,
food
This
service
is only,
is like.
yeah, this is just for police and fire, the two open plans.
Yeah.
So again, hopefully you guys will get this soon, but I'll continue on. So on slide 9, I'll just skip to slide 9. So we set up, we bought a house. We're paying for that over a 30-year mortgage. In the next year, we add an addition to the house, and apologize for my example here, but that cost $131,000. So this is a loss. Right? Well, that loss would be separate from the legacy unfunded and paid for over its own closed 25-year period. So it has nothing to do, the legacy unfunded, which you would set, would be amortized and paid off over that 13-year period, 12 now in this next upcoming val. So we wouldn't touch that. And then on slide 10 is just, if you had a gain, you won the lottery, you had a gain of $92,000, you would have a separate base for that. Again, this just is controlling the volatility that could occur in the contribution requirements. That's all this methodology does.
So let's say we had a loss in 5 years. What time frame would that be spread over in the case of the police and fire pensions?
That would have its own base and be spread over its own period. I recommended 20, we could do 15, we could do 10, I've had plans that do 10 years. It's all up to the board of how much, again, the longer period, the less volatility you have, the more you can spread over, pay for it over time. If you have gains, like, we're gonna start recognizing investment gains. You've had 3 out of 4 good investment years. We're gonna start seeing those investment gains hit, so we're gonna start seeing some gains. And that, again, will control that volatility as well.
And right now,
Even
those
in the
gains
reduction.
or losses are
There's-
taken in the current year.
Yeah, so again, it's just, a lot of public sector plans have gone to this separate base thing. And again, I can show you a better example when I come back for the VAL, just to show you what the VAL would look like if we did it that way. But just,
So when people do this, what timeframe do they, is most common?
a lot of states are doing 25 years. I don't recommend that. It's just too long of a period. The actuarial community likes their experience gains or losses over a 15 to 20-year period.
Why not 5 or 10? Is it too short to get the benefit of the spread,
It's just, it's more volatility.
Yeah.
We're just trying to stay.
but a lot
away from
less than
that.
we have now,
It would be more volatility by 5, because you're over 13 years.
over
now.
13 years.
Yeah.
So if you don't go over whatever's remaining in this closed plan, if you don't spend that additional amount out over what's remaining in this plan, then you can't get the benefit. The lack of volatility, the less volatility.
Right, if you
It has
just,
to be a longer
if we
period
just
of time.
stay on path, which is fine, we'll be 100% funded in 13 years. Guarantee it, though the contribution may go like this, depending on your experience. What I'm saying is, in 13 years, you will be at or near 100% funded. You won't be exactly 100% funded unless, but your contribution will be level.
Yeah.
Or more level. It'll be more zigzag, it'll just be less volatile.
What are the
But you'll be
parameters?
at or near, depending on the experience gains or losses that you've had over these next 12 or 13 years.
How's the 13 determined?
The 13 years was determined on a closed basis years ago, I think,
Right.
when they reset it.
When we set it at 20.
Yeah,
Okay,
so that was before we became the
Right.
actuaries, but
Okay.
yeah,
That
but
was
it's,
7 years ago.
yeah.
Let me see.
All right, so I think these, I'll go on to slide 11 because this fits right perfectly into it. So now we're gonna talk about assumptions, that was just the method section. The assumptions that we're going to propose to you all are kind of all long-term in nature. This is for at least the police and fire, our long-term pension plan is gonna be here for a very long time, have still, open plans. Still, the city and food plans are gonna be around for 30+ years still, even though, there's still 40-year-olds in both of those plans who are gonna live to hopefully 90 years old. And so these plans are gonna be around for quite a while, but for the most part, we're talking long-term in nature, our assumptions. I make recommendations to y'all, but it's ultimately, the great discussion we're having is the responsibility and the adoption is from this body. So we can talk about and make recommendations, but you guys ultimately make the decisions. All right, slide 12. Basically, what you're gonna see a lot here, when we talk about our experience, we're gonna talk about actual experience versus expected experience. We currently have assumptions, but how did the actual experience match the expectations? So we call that an AE ratio. So you're gonna see that a lot, from our. We don't necessarily set the assumptions to match what we just saw. Right, and we're gonna talk a lot about this, especially on the police plan. What's indicative of what just happened the past 4 years may not happen in the next 5 years. We've had a ton of retirements in police plan. We've had a ton of withdrawals in the police plan, disabilities. Is that really going to happen over the next 5 to 10 years? Who knows? But, but I don't want to go all the way up to what those levels are. The past 4 years, we all know what has happened across for police departments across this country. There's a lot of exits going on across the country. So this is not surprising for your plan as well, but is that going to be indicative of what's going to be forward? I would rather not go all the way up to what we just saw, but somewhere in between and kind of set assumptions in the futures for somewhere in between.
Don't you think that one of the reasons the disabilities are so high is because, if I'm not mistaken, disability payments are tax-free, right? Federal taxes. So, when like over 90% of 4 or 3-star generals retire
Right.
on disability, and for the pension plan itself, the payout doesn't really change.
Right.
I mean, if we give a guy $1,000 a month, rather, $2,000 a month, whether they pay federal tax on that or not, it doesn't impact us.
Yeah.
So the disability kind of is critical, unless they're saying, okay, I've been here 7 years, I got shot, I can't.
And disability is such a small component of the cost anyway, yeah, so us tweaking assumptions doesn't move the needle at all. I'm gonna skip over to slide 16. Have you guys gotten the presentation now?
We did, yes, thank you.
Awesome. All right, let's skip over to slide 16, because a lot of the other stuff is what I've already said. Well, let's talk about inflation. So inflation is a component in your plan, really is a base for payroll growth, investment return growth. And while COLAs are kind of set at 1.5%, it's obviously a component of that as well to say, are we meeting our cost of living expectations in the future for the retirees? So the current assumption is.
I mean, is the last contract that still set at 1.5%? The contract with the city workers, because it used to be there's a cap on the cost of living adjustment of 1.5%. Do you know if that's still the case?
The cost of living is probably one in it, but that was, there were 2 components to the increase, right?
I think
There were 2 pieces of the increase. I think it was 2.35% was the total.
Are we talking about the COLA increase?
Yeah.
For
For the
pensioners?
pensioners,
Pensioners is 1.5.
it's still 1.5.
Yeah.
Okay,
Yeah, it's for the closed plan, I think it's deferred. They don't get it until 60
Until
now.
they're 60.
Yeah.
Mhm,
Oh,
right.
or over.
yeah, all right,
I thought
thank
you were
you.
talking about the salary increase.
No,
So current assumption is 2.6. And then on slide 17, we just looked at, different sources, all over, the world who kind of come up with these. We're actuaries. We don't have economists on our staff who are looking at this, like the group, that you just spoke with. So we take what experts are kind of coming up with, what their expectations of inflation are. We feel that 2.5% is a good assumption. It's very comparable to what you're at. But we like to follow the longest term. The Social Security report is 2.4%. So we're recommending that the board consider a slight reduction to 2.5% going forward.
Can you show us any sensitivity analysis around that? If it was 2.5, or was it 2.75, what the impact would be? Because that would give us a much better feel for we're going to be wrong. But it's
as long as there's 2 in front of it, you're wrong.
well, we're predicting the future if you're.
I certainly can. We can do that. Again, so let's talk about the investment rate of return. Because inflation is a component of that. And our investment rate of return is the most critical assumption. So we use that to discount all the future benefit payments back to the valuation date. We value expectation of our growth and asset amounts based on this assumption. This board on slide 19 has cautiously reduced this down to what I consider a very reasonable assumption at 6.5%. Using, so the basis of the building block approach of the 6.5 is 2.6 for inflation and 3.9 for real rate of returns. If we take your asset allocation and we look at the Horizon survey, which I believe Callan provides their capital market assumptions to this Horizon survey, and they look at 42 investment consultants and their capital market assumptions. And we throw that in and do a log normal distribution, we come up with a nominal return on average over a 50-year period of 7.3%. So 6.5% is very conservative, and you're looking on page 20, the median of public sector plans across the country is right at 7%. It's kind of been hovering there now for the last 3 years, maybe 4, and it really hasn't moved in the last 3. There hasn't been a lot of movement. I think everybody's gotten, we were all at 8.5 back before 2000. Almost all the pension plans have come down to this 7 to 6.5 range and are kind of holding steady, I think, at this point. So I think you're at a good place there.
The height of the bars here, what is that?
So
Is that a number?
100%. It's 100% of all the plans. So this was a survey of NASRA. They have about 140 plans that they look at.
So we're saying,
You're in the lighter cauliflower
Right, so-
blue.
so we're saying
think-
that we're looking at somewhere about 40% of the plans are 7%. Is that what this is saying?
Probably, yeah.
Okay.
I mean, it's not, if, I am not predicting rates rise or anything like that, but there could be a possibility. We've gone to 6.5. We could go back up to 6 3/4 if, if there was, that would change the amount of money, then that would adjust the assumptions. And then when you talk about like a real bad hit, that would be a way to say, well, it wasn't such a bad hit anyways, because we're now thinking it's 6 3/4 instead of 6.5.
Right. Yeah, and I didn't include Callan's numbers. I'm sure they go over that with you on a monthly basis, and their expectations of what you guys hit and move things around. So, but I'm assuming you agree 6.5 is a very reasonable, conservative assumption. So on slide 21, so our recommendation again is real rate of return at 4%. I think that fits within the range of what we saw on the Horizon survey, and assumed inflation of 2.5, and then the net investment return of 6.5. So no change in how we develop our liabilities. It would still be based on this. Where the inflation component would come in, if we were to go to 2.75, would be on the salaries. I would want to run that with higher salaries going forward.
Before you leave
Of course.
page 21, so. Kevin or Britt, so if we're assuming 6.5 overall, kind of what's that mean for equities? This is a blended based on our asset allocation, right? So equities would be what, 8?
That's page 19, isn't it?
They're a little lower than that, Jim.
Yeah.
Seeing them up now. So we released these. I'm not sure if anyone was able to join the webinar. We have brought our equities down to about 7.3 over the forward-looking 10 years, and that's largely because of valuations within U.S. equity. International equities, similar, not as rich in valuation, but similar in terms of 10-year forward-looking bogey.
What about fixed income?
Fixed income we brought down given the drop in rates from the Fed. So it came down to, bear with me here, So our core US fixed, which is the ag, we're now projecting 4 3/4. So that's down 50 basis points, largely due to the Fed cutting rates and, the starting yield, where we are currently, is a pretty good indicator in terms of fixed income going forward. I think in terms of the pension plan, the last time we did an asset allocation study and took a close look at this, I'm just going to pull it up now.
Yeah, how close is the 7.31?
And keep in mind too, that the capital market assumptions, they don't include any alpha. Right,
Yeah,
so like.
purely
and then
based.
Yep,
Just beta, yeah.
but the bottom line is 6.5 would be in the range that you guys would support, maybe on the lower side.
Yes.
Yeah,
Smooth.
I think it's a really attainable return over the long term. Our assumptions that we ran the portfolio through in 2024 were, we're projecting a little over 7.3% return, something in that range. I mean, obviously, as Cavmac mentioned, this is not a science necessarily, and there's definitely a lot of art. So, I think broadly speaking, public pension plans have brought down their discount rates to attainable levels over the last 10 years. And Norwalk has done that very regimentally, which I would applaud because, having an 8% discount rate is not necessarily attainable and wasn't when interest rates were at 0.
Right.
So the ability to not take as much risk to achieve your return and the path to achieving that return, I think helps the city in terms of contributions going forward.
And these numbers are all gross as opposed to net of fees.
Yeah, because again, it's
Yeah,
just
it's the
beta.
market, yeah.
Yeah, it's just the market, right?
Britt, when was the last time you guys did a capital markets update? It wasn't that long ago, was it?
So we did an asset allocation study with you last year. I think maybe at the next meeting, we can review our capital market assumptions to walk you through our thinking.
Yeah.
And it's,
I think
sorry, go ahead, Chris.
I was just going to say, I mean, largely, we're not going to make huge changes to these assumptions. They're used for long-term strategic asset allocation planning.
Yeah.
We do take into account the market environment that we've seen, the last 2 years, the US equity, particular large caps. We were looking at valuation and got to the point where our team said, you know what, I think we need to bring down our expectations going forward here. So it's on the margin and we wouldn't recommend huge changes to an asset allocation necessarily because of those, but we're happy to review them with you.
Yep.
But it's been fortuitous in terms of sticking to the plan, in terms of working down the discount rate in such a strong market, right? So when I think about like on a go forward basis, if we don't have these same types of market returns year over year for the next 5-10 years, those plans, those cities who haven't been, dropping and sticking are going to have to all of a sudden make large contributions,
raise taxes
alongside potentially weak, if not negative returns.
Yep.
And therefore even larger contributions than they should have. So it's, the shorter term maybe pain to the city sets it up. Is that fair to say, like over the next 10 years, hopefully in a better position? And again, it's just all about that smoothing effect then.
Yeah, I think this plan, all these plans are positioned for the next, 5 years to be, we've reached that bottom now. So like you said earlier, I think the next 5 years, we're gonna be, heading back up, if hopefully in our funded ratios and our contributions will stabilize. So it's, we've gone through the pain of getting down to 6.5%. And it's come with additional cost, but it's, I think going forward, we're in a good trajectory.
Do you recall where we were in percent funded the last time we looked? I mean, it's varied by plan, but
Yeah, it varies by plan.
it's kind of the range.
Around 75.
75,
Yes, yeah, 75 in total. I think the city's is 78.
Yeah.
But then the other ones are 74, 72.
Okay.
All right, slide 22. we'll get into some of the demographic, assumptions, talk about salary increases first. Salaries are currently based on service. So it's a service-based table, dependent on, you know, the lower amount of service you have, the higher percentage of payroll increase assumption we have. And that's what we typically see when you're first hired. Your raises are typically higher as a percentage of your pay. And then when you get more experience, when you after you get promoted a few times, the percentage raise you get is more inflationary basis, 3% or something like that. So all of the plans have a basis like that. Now, the last 4 years have seen higher than expected pay increases for all 4 of the plans. They vary by year, but I think this is kind of a follow-up of what happened to inflation at 9%. Is salaries had to kind of catch up, and it took a few years, but they're fine. You know, we're starting to see those. Well, as I always say, salary increases come with a burden at first because they increase your liabilities. But the good thing is that now you have a higher salary base. There's more contributions coming into the plan, because they're paying in more, right? So that helps the funding in the long run. So you get hit with it first, but you pay for it over the time. But you know, I think, you know, even though I'd like to just sit on, and not make any changes right now in the salary increases, and let's wait and see, and it kind of goes back to normal after this 4-year period. So we, you know, again, this is the art, and not science of it, of saying, you know, do we think salary increases, everybody's gonna get an 8% salary increase going forward? I just think it's gonna return to more normal levels of what we kind of assume. As far as mortality, on slide 24, so the mortality table that is currently being used is an RP 2014 table that, you know, don't worry about the years, that's just what it's called. But there is a new set of mortality tables out there. And it's based on public sector data only. So it's right in all of these plans' wheelhouse. It only has data for police officers, firefighters, general employees, teachers. And the new table, which CABMAC was a big part of organizing, we've used this for the Connecticut MERS plan when we did an experience study for them last year. And it kind of fits in well with the Norwalk plans as well. So we are recommending that this board adopt this new they were developed, even though the date says 2010, that was really the year it started. It took 9 years for them to gather enough data to have a good table. So they actually was released in 2019.
We use the same table for all of our plans.
No. So it would be adjusted dependent on if your city and food, the bottom bullet there, you would use for general participants. And then for your public service participants, for your police and fire, they actually have a separate mortality table that would be used.
Okay.
Now, it's a table that is using data from all over the country. What we do is take that table and then look at Connecticut specific mortality. And that's why we kind of bring in MERS and even CSRS into this mix, because they're much bigger plans. They have a lot more depth that we can review and develop a table. So the last bullet there is just kind of further adjustments to kind of match Connecticut's experience. And Connecticut has some of the best mortality experience in the country. I mean, it's always in the top 5.
Yeah,
State that to go retire in.
right, rather than use the average in the.
Right.
Right,
so
but
we
that means
go
that the
specific.
our funding.
It costs more.
Right, costs more.
Because your life expectancy here is longer, is longer, so it just costs more.
Have we been using the same table for all the plans previously? Is this a switch to the separate
Yes, you've been using that RP 2014
for
table.
everything?
For
Yeah,
everything,
okay.
yeah.
And you'll show us what the incremental changes.
It's in the report.
Okay, good.
Yeah, would you like to see the change just for mortality and other?
Oh, it's all in here?
Well, I've got we'll show you the cost impact of everything,
Okay.
but I can do that split up. We have that as well. All right, so let's talk about terminations. We sometimes refer to this as withdrawals. We're on slide 25. So terminations are those folks who leave the system before they make it to retirement. They're either vested or not vested. So, so the police had the largest discrepancy with actual to expected. They actually had 18 actual terminations versus we only expected 5. We typically in the public service department don't get much terminations. Once they're in, they kind of stay in and are there until they retire unless they kind of move, but we saw a lot this year, as we kind of talked about, and you can see the
But can I-
numbers. Yeah, of course.
But if somebody leaves with 4 years, then.
Right.
So.
That's a good thing to the
That's
system.
right, but, so the 18 could be, in
Some of them are good.
some are good and some
Some
are,
are-
okay, but do you have that number? Cause I mean, of the 18, it could be, I mean, in actuality, affecting the plan,
Well, actually, all withdrawals are good, to be honest. So this is a good thing
right, but.
for the
but
system. We saw
if you-
gains.
If you have 10 years in and
Right.
you leave,
Right.
you come back at 60 and then you say, okay, I want a pension.
Right, but that's still, I mean, the people who leave before vested are gains to the system because they're just taking their money and going. But you've now collected dollars that they're not gonna get. You've already put that into the trust fund, so you're gonna get a gain on those.
What
So
about-
typically withdrawals are gains.
Do you know that why the 18, that's pretty high number. I mean, did people leave? Were they fired? Were they go to other places? Do you know what I mean? Do you have any, because that is a big number.
Why they left the plan.
Why they left the plane, why they
Early.
left, I mean,
Or left the
We don't get the
employment.
reason why.
Don't you,
know.
isn't there, like, hasn't the trend been that you see a lot of police officers from like the Northeast go down to Florida and join the police force down there somewhere? It's-
I know some that you, right, they advertise that to get them to go down there.
Right,
But even like, I mean, like the city plan, for example, a while ago, remember, we had that 55 people left. Because and they were all people who were in the plan. And the new people, none of them went into the plan. I think it was 54, right? Or some in the
Something
50s.
around there because of the
Right.
package.
Right,
Mhm.
so, and so that could affect the plan, why those people are leaving and how they're leaving. Right.
I mean, it's interesting because they're fully staffed. The police force is fully staffed and they don't seem to have a lot of trouble like a lot of other cities are having difficulty finding police officers and staffing up, and Norwalk has been pretty good, so. Which indicates to me that the compensation doesn't seem to be a big issue. So those 18, I don't know what to say about those.
if the numbers make sense, right? I mean, for them to go out, then,
Yeah, I mean.
because it's like an average, right? Like your last like 5 years or something like that. So if you're working a lot and getting the overtime and doing all the,
Not the overtime.
Not the
They don't have
overtime.
The overtime.
okay,
Right.
okay.
Yeah.
Yeah,
Is this a critical assumption going forward?
Withdrawal it's a minor, it's more than disability, but it's less than.
If it's
retirement.
minor, then there's probably no worth digging into it, but yeah, if it's a
But
major thing.
But we're recommending an increase, a little bit for each of these, as you can see, all on slide 26. The expectations were short for all 4 of the plans. The city, we expected 22, we got 33. The numbers down at the bottom.
Mhm.
Food, we got 4. I mean, we expected 4, we got 7, and then fire was pretty close. I kind of chalked that up 5
What is
versus
the,
3, it's really close.
So like under 5 years, the 0.3, what's that mean?
Yeah, so that's the number of folks the percentage of folks that left,
0.3% or 30%?
30%.
30%, wow. Ooh.
Now, there's not, the city plan has been closed for a while. So this is going back a few years. There's nobody less than 5 years anymore.
Mhm.
Yeah, there's nobody less than 10.
That's true, yeah, so there's some stragglers who don't have full 10 actually. Even though it's been closed for 10, they didn't get a full year of benefit service. They had a leave of absence or something like that. So there are a few who have under 10 years of service.
So let me help me understand, the under 5 though, the 30, so what, who's in that group? This is, they were in the plan.
Again, we could be talking
Three
4 people, 5 people, and,
All
you
right.
know, two left.
Not
or
meaningful.
something like
Okay,
that.
got it.
Yeah,
Yeah.
yeah. Again, then, it's the same chart in the report, but if you wanted to see more numbers, we could break that down for you very easily. All right, going on to retirement. So now we're talking those folks who've made it to retirement age. These are set basically at every age and service combination. We have a probability that someone is going to retire. So when you reach 55 and 25 and you're eligible to retire, we have a probability or an assumption that's that 30% example of people who reach that will retire at that point. So we have an assumption for every age and service combination. We saw actual retirements again were more than expected for all the plans except food. The police had the most. They were 18 retirements versus only 9 expected. And the fire plan had several retirements from participants before they even reached age 50. So we're recommending adjustment to these rates again to reflect the experience.
How many fires get retired?
On the last page, 5, right? 5 versus 3.
No, the fire plan had 9 retirements versus 8 expected, so pretty close.
Okay.
But what we saw was a lot of folks retired at age 48. And we didn't currently, there was no assumptions for anybody to retire at age 48 in the fire plan. Because they had the 25 and out, they could go there, but there was no expectations of anybody going there. So that's one of the recommendations is we're recommending, the police has it, but fire never did. Had assumptions there, you know, so we're recommending rates there as well.
The drop plan, you don't count those until they're out of the drop plan, correct?
No.
They're not counted as retirements.
No, for the drop is, so when they go into the drop, even though they're not officially retiring, they're earning a benefit. And then in 5 years, guess what? They earned all of this. So we like to say that they left at 48 and went into the drop. That's when they're retiring. Because that's when the benefit starts. You're not paying it for 5 years, but it's being accumulated for 5 years or whatever period they're in the drop.
But do you include those in, if
Yes.
you're saying 18, the drops are included in
That's,
there?
they are.
Got it.
Yes.
Okay.
Does the fire have drops now too? Does fire have drops?
Oh, they have,
I think they do.
they
Yeah.
do,
Yeah, I think it's fire. You see it.
fire and police.
What are drops again?
Deferred retirement optional plans, programs.
Okay.
Basically, they go into a drop and their benefit is calculated and say it's $3,000 a month. They accumulate that for however long they're in the drop for 5 years, 3,000 a month. I can't do math. That's a lot of money. They receive that money as a lump sum in that, after that 5-year period. And then they get,
Salary, and then they
They still get
pension too.
yeah, they get their salary for those 5 years. That $3,000 is accumulated for
They're still
5
working.
years,
Yeah.
still working. Then they officially stop working.
Mhm.
They receive the lump sum and then they receive $3,000 again for the rest of their life.
It's expensive.
It's expensive.
It's expensive for the
That's
city.
Yeah,
Why,
that's,
why are they allowed to do that?
This was negotiated, I don't know how many years ago.
Yeah,
Most of it.
it's been around
Yeah,
a long
it's been
time,
around
yeah.
there.
Crazy idea.
it's, Yeah, it's funny.
I think they did it at a time when they were having more of a difficulty hiring.
Yeah, it's a retention tool, you
Right.
know, to try to keep those guys around, a little bit longer.
What percent of the employees use
Huh,
that?
Probably a lot, yeah. It's
Good deal.
utilized a lot, especially for those, for the
Yeah.
police and fire.
It's
It's
to
you,
everybody.
it- to all, at least environment.
Yeah,
Yeah.
both sides, yeah.
I mean, there's drop plans all over the country. They're primarily in the public safety
Mhm.
environment. They just introduced legislation in another state for teachers to go into a drop and it was
Oh, boy.
killed
Oh my
immediately.
gosh.
Anyway, all right, disability, we're almost done, I promise. Disability, again, very minimal, assumption, but again, like we said, we did see a lot of, police disability 7 versus 2. Again, when we're talking about expectations, that's a lot, but again, so we're recommending increasing the rates just for the police plan, no other changes. So again, now, 29 and 30 are just kind of the summary of our recommendations to this board. Just to go over it again, just a little bit slight reduction on the inflation, but keep the nominal investment return the same. And then, for our demographic assumptions, for retirement, increasing the rates, this is on 30. Increasing the rates for police and extending rates, to age 48 for the fire plan. Termination, simplifying the rates of withdrawals for all plans to a service-based table and increases to the police plan to better match the experience. Disability, increase to the police. Salary scale, no change, and then for mortality, recommend changes to this new public 2010 family of mortalities to match Connecticut murders.
Do you know whether the disability, say for the police, are they, do you know what roughly, are they like some of them retiring with like 10 years or 12 years, or are they going, 20 and then they're saying, okay, I'm disabled? Do you know what I mean? Like,
Yeah, I know exactly
because,
what you
because
mean.
if they retire and
Yeah.
then 12 years disabled, they're starting to collect a pension,
Yeah,
they could be collecting a pension at 35.
yeah, there were 13 disabilities over this 4-year period, so there's not a lot, but the majority are typically. For some reason, we always see this around 45 to 50. I don't understand why, but it's that range of, and I just passed that range, so, I don't know what it is.
Okay.
Just, but yeah, that's what we typically see, but again, we can go through the data and get you
No,
there
I just-
as well.
I was curious.
Yeah. I think it's because they've reached a time where they want to retire, but they can't quite retire, and it's like,
Until they hurt
yeah,
their-
my back
until they hurt
hurts.
their back.
Right, exactly. All right, so, the last slide 31 is just kind of, the impacts of all of these assumptions. I know we've talked a lot. So we've got the 4 pension plans here. And I'll take one at a time. So the upper left is the city's plan. So currently, the 2023 Val has an unfunded actual accrued liability. That's what UAAL means, as $63 million. These assumptions would lower that to $58 million. So all of these assumptions would actually lower the liability for the city plan. It would make the funded ratio go from 77.8 up to 79, and it would lower the contribution requirement by about $300,000. Again, all of these assumptions, if you adopt them today or at the next meeting, would go into effect for the 2024 Val. This is just a kind of a comparison of the 2023 numbers. We'll go over to food. Food, again, has a reduction in the liability as well. It's a slight reduction, and just a slight reduction in the actually determined employer contribution, the ADEC. All right, the police plan. This has probably the largest impact because of we're moving retirements high, more retirements and that kind of stuff. So the liability is going up by about $4 million from 56 million to 60 million. The funded ratio goes down slightly, and the actually determined contribution goes up by about $500,000. And then for the fire, the liability goes up $2.6 million. Funded ratio comes down and the contribution goes up by about $430,000. So, so again, overall aggregate, a slight increase in the actually determined contribution due to these assumptions, mostly due to the mortality change, because it is expecting longer lifetime of folks because, you know, of where we were at and that kind of stuff.
Slightly is how much? You said the aggregate impact on the.
Oh, in aggregate over, I think, it was, what was it, 500, 450
Plus.
or 550 plus. Maybe about,
Plus 29.
yeah, it's about $500,000, yeah, in total, I think,
Okay.
so.
Does that contribution now stay pretty steady now going forward? Or
We're
and that's
hoping
what we're
so.
trying to smooth that out based upon that?
Yeah, yeah, so again, this next vow, now. We're gonna incorporate any of these changes, again, that you adopt for the 2024 valuation. We should see a good asset investment return. Because we've had another good investment year. The smoothing should be better than 6.5%, where that will help offset some of this increase. So we might not be here in a couple of months, hopefully, and say that we're asking for that much money. But now that we've reached 6.5% and we've got really good assumptions, we feel going forward. Yeah, we don't see the volatility occurring. And I think you'll see that hopefully in the projections that we always show you during the valuation meeting.
Do you know what the contribution was? What the contribution was last year or in the budget for July?
It was 21.2 million
Yeah, Jared, I gave Jared those numbers.
this year, the current fiscal year.
Current fiscal year. So this doesn't really move it up much.
So in one of your recent presentations, I think there was some discussion about sort of the quality of the city data. Do you remember that? Is it better? The same? How would you characterize it?
We're still working on the 2024 data.
Okay.
Yeah, it's
Are there any particular things that are issues?
getting it. I don't, I love these people a lot, so I don't.
We're all
wanna
here to
throw
fix it, so don't worry
Anybody,
about
yes,
that.
exactly. You know, I think, you know, getting the data, once we get it.
Yeah.
It's getting better, for sure,
Okay.
but I think it's just, you know. It's coming from so many groups that it's hard to get and combine it all to get to us.
We don't have a combined one HR system?
No, I mean, we get stuff from Board of Ed and then our, human resource. So we kind of take it from all different direction and on our system, there's no really one source.
Well, Board of Ed's not in our numbers.
Food services.
Food services,
So
okay.
it's
But also the people like the people who work for the Board of Ed who aren't teachers, that like the secretaries and that, right?
Correct,
They're
yeah.
also.
So they're part of the
they're
city
part of it. It's
too,
just-
yeah.
Yeah, we had.
And they're in the OPEB, the healthcare plan
Yeah.
as well.
Mhm.
Yeah.
You know, one of the things in the past, we've got numbers where projecting out, say, 20 years where the fund would be.
Yeah.
Do you have any of the numbers like that? I mean, like, when does the fund start to really?
Yeah.
Accelerate downward in the holdings, you know what I mean? There'll be a time, say, in another 10 years, where virtually no one will be paying in. Right? I mean, we
For
started
the
in
closed
2012.
plans, yeah.
So in the closed plan. And there'll be more, you know, like, we had somebody retired tonight.
Right.
That person no longer pays in.
Right.
And they take it out, and every time we have somebody retired, that's basically the case.
Yeah.
So is there a number there where you say, okay, well, this is where you're really starting to decline?
Yeah, so we're gonna see that soon. I think we showed in the projections and within the next 5 years where we kind of get to a point and then we start to level off the contribution. So yeah, for the closed plan, it's going to be tricky. It's going to be kind of get a trust fund big enough to be able to pay all these benefits without getting a lot of employee contributions in. We could still get city contributions in, but that's gonna be the bogey of calculating all of that. We might wanna consider, and I don't know if the assets are pooled together or if they're separate trust funds, but getting even, once there are only retirees in, 15 to 20 years, getting a little bit more, even more conservative in the assumption
Yeah.
of what the growth assumption
We
is.
have.
I don't think we're there
No,
yet.
we're not
Yeah.
there, and, but I do agree, there's a point where the, say, police and fire, they might wanna be in, say, higher risk, longer term.
Right. Yeah.
Investments,
Different asset
whereas
allocation.
the allocation could
Right.
shift.
Exactly.
But right now, we have everything pooled because obviously, as a result of that, we have lower
Right.
rates and,
Fees.
fees rather.
Right, exactly. So it's hard.
I think that would be, it'd be helpful for, if you can provide guidance on when we need to really start aggressively planning that.
Okay.
That's gonna-
Yeah, again, I don't think you're there yet. I mean, the average age in the police plan is 58. I mean, then the city plan is 58. So but there's a lot of people over 70 that are still active in the city plan. So there's still 40-year-olds.
Okay,
So again, I don't think that's
less than 10 years,
something.
we should start really thinking about it.
Yeah, I think 10-year mark would be good to see how many active members we have at that point,
Yeah.
you know?
Thank you.
Yeah,
Yeah.
you're welcome.
Anything else you'd like to tell us?
No, I was just happy to be up. I
Yeah.
feel like I'm home. This is where I grew up, so,
But it's
I
nice
love
that you-
seeing the snow. I don't get snow in Atlanta, so
Right,
this
but
is
it is nice that you come, I do like to see somebody in person because like the guys we
Yeah.
were talking before, we would have loved to have him in the room.
Just happy to-
He's been bloodied and crawling out the door.
No, I'll be up here at every
Happy
meeting,
to work
whatever
with
you want. That's fine by me.
So
Good.
anyways,
All
all right.
right, thank you very much.
Thank
Anything
you.
else? Okay, thank you.
Yeah, we'll make it
Quick,
quick, tight, all right.
Because that's because Jim's not running the meeting. If it was running, the meeting, we'd all been out here an hour ago.
Yeah,
I'm
yeah.
efficient, what can I say?
I didn't want to say anything.
More information.
I could get disability, my.
There you go.
Just starting, as always, at kind of the high level, the macro level, lots of macro talk tonight. End of the year, we kind of limped into the end of the year. A lot of that euphoria from the election died off. We saw US stocks down, just about 2.5%. Value stocks really kind of bearing the brunt of that. They were down 6.8% for December. Growth was just up, just shy of 8%. Small caps, they lagged. They were down 7.5% for the month. Global equities, actually fared a little bit better. They fell 2.7%. Most of that in the EV space. EM was down or almost flat, down 0.1. Fed did cut rates 25 basis points during the month. Expectation in terms of their, at least based on the dot plot surveys, for 2 cuts in 2025, call it 25 basis points each. The 2-year remained pretty flat, 2-year treasury at 4.2%. We did see long bond yields rise, though. They're pretty sharply. We got about 40 basis point pop on the 10 and the 30. And then credit markets are, they stayed pretty strong. Spread levels really tight, as we kind of talked about earlier. Investment grade still below 80 and high yields below 300 basis points. So those haven't unwound as of yet. Taking a look maybe just on page 2. So we've got the fiscal year to date, the 1 year and so on. what I will say is that for the fiscal year to date, which is the last 6 months, 4.3% versus the custom benchmark of 4.14. And with the exception of the 1 year, if we look at the 3 year, the 5 year, and even the 7 year, we'll call it, almost flat across the board there. The 1 year, again, we did see a bit of a dip there, but we are notably ahead of the discount rate over those longer term time periods, those 5 and 7 years, which is, what we always hope for. So it's good to see that. Looking at the underlying allocation, fiscal year to date here, pretty strong returns for the US equity side of things. Principal was the top performer on both an absolute and a relative basis. Frank, do you have a question?
No, but I was just gonna eventually ask about Walter Scott.
Yeah, I have some comments there. So, just principal, good to see them. Really has a couple of bounce back quarters as well as years here. Pretty strong fundamentals as well as positive earnings surprises were rewarded during the last 3 to 6 months, and those are two qualities within their portfolio that they kind of lean heavily into. They did note that, I chuckled a little bit. One of their top contributors was MicroStrategy. So if anybody's familiar with that, which
Yeah,
is essentially like a Bitcoin machine where they're buying Bitcoin with excess cash flow.
They're issuing bonds, taking those bonds and
Right.
buying Bitcoin.
Right. So,
It's the worst.
I agree.
How they have that in any kind of an index is beyond me.
So, I
It's the largest cap in the largest weight in small cap.
Right.
Yep.
They're a
It's a
software cloud services company, but really they're just a Bitcoin investor by and large. And given like the Trump play and the onset of cryptocurrency, they have really benefited from that
And then
exponentially. So
For now.
they issue convertibles at a lower volatility than the asset that they're buying, the Bitcoins.
yeah, it's
I
levering.
mean, it's.
What's the yield on those bonds? I'm the only kidding, I don't care.
Oh, man.
Some of the other names they had in there, Robinhood, who did better, expected on the trading activity for equities and crypto. Other on the US, on the flip side, LSV actually continued to struggle. I mean, I know I mentioned earlier that that value has been down overall. But their quote unquote version of value, which is things like stocks that are cheap on multiple measures of valuation, cash flow, earnings, book value, dividend yield, those have all been laggards. So has really kind of weighed them. Again, even though value has been down, they have still underperformed the Russell 2 value over the last, I guess, 2 years, let's say. I know the 3-year number is quite strong, but they've given a lot back more recently. International side, this was the biggest detractor over the last 6 months. Both Tilchester and Walter Scott really struggled. Walter Scott was the largest detractor, again, both on a relative as well as absolute basis.
How much of that was China? The China rally.
I don't think it actually was per se.
Well, that's developed markets.
Yeah,
So
that's in
China
the
would be
developed
EM
side,
markets.
right.
Yeah.
They're really focused on earnings growth, and that's more in that developed space. And that's just something that hasn't been rewarded. So durable growth, profitability, balance sheet strength, and then throw in the fact that for them, valuations really matter. So they're getting clipped on both sides in the sense that there's names that are trading at valuations that they're not going to buy into. And then some of the names they hold, which are, if they're getting elevated, they're going to trim those. So it's putting them, and I've seen this with other managers too, it puts them in a really awkward spot if your parameters are too tight. Because the names that you want to own are just getting away from you. And then the name, you're almost forcing yourself to sell. And then what do you do with the cash, right? Because so it's.
And
you
I
know,
would
it's-
just,
Go
I
ahead.
would just add, Walter Scott, their philosophy is deep fundamental analysis for that quality, durable growth, which has clearly been out of favor. This is across all of Walter Scott's products. So I have a number of clients that have their global equity strategy, which again, we think very highly of the team, the philosophy, the process. It has really just been out of favor in terms of their performance, and they've struggled in this kind of narrow market that we've seen.
Yeah, it's one of those tough ones to digest, because they'll tell you they're sticking to their process and their philosophy, which is what you want to hear, but at the same time, it's like, I wish you would almost change something. I mean, that would be a major red flag if all of a sudden they change things up, but it's a little bit of there's just like the cyclicality to what Britt was talking about, just those tailwinds are not in their
And they
favor.
might be a good manager to have in next month to hear directly from
Yeah.
them,
Is
given
there a
their.
relatively newer one too, right? Yeah.
So you want to Walter Scott next month?
I
That'd be
think so.
good,
Yeah, we can work on that.
unless anybody has anybody they really want to have in.
Yeah, that's good.
That's good.
UBS, continues to do a nice job there. We don't have attribution to speak of just yet. But it's been a strong, kind of diversified contributor to the portfolio all along. And then, DCW, we can debate here in a second. I don't think I necessarily need to repeat in terms of performance. I was looking back and if you recall a quarter or two ago, they actually were up and they just gave it all back in the last like 3 months of the year. And again, I think mainly because a lot of that duration play, but
While they were presenting, I was looking through our research team's portal, and we have attribution on the Core Plus strategy, and it's interesting to look at the duration contribution over long time periods where 10, 15 years, it's really muted. And in more recent times, to the discussion earlier, it's been amplified significantly and detracted virtually all of the value that they're creating within their security selection and their sector allocation. So I'll circulate this to the board and then also follow up with them on the attribution Rich requested.
That's, you asked for that.
Yeah.
and that makes sense based on that line chart they had,
Yeah.
because they were always under up until the last 3-4 years.
Yeah, the performance. is-
It's how they. Why, again, it gets back to why they need 600 people if they're just gonna make that big bet.
And
There's no way you can earn yourself out of that hole if you're wrong.
yeah, I guess I struggle with the idea that if you're looking for a Core Plus and you all of a sudden you find out you bought a macro manager, to your point, like why not just go neutral, not try to make a judgment call on that part of it and focus in on where you think you have a skill.
I think we're gonna have an executive session on that.
Yes.
anyway.
We're gonna talk about that, because Rich said that he wanted to see actually Wes come back in next, because he had so much fun beating the guy up.
We're still on topic.
Well, let's go to the executive
Yeah.
session.
Yeah.
Let's save it all.
Anything else? So we're gonna go in it,
Yeah.
okay,
Thank you.
And,
thank you. If any, there's nothing else?
So,
Oh, we have left? No, we have to, all we have left is to say, is there any other business? And if not, is there a motion for adjournment?
we need to decide on these recommendations.
If you want to, go over it, you can, we can. I mean, we didn't,
Well, we had some recommendations. We want to do anything with them or sit on this until the other topic, the RP gets.
We might have to wait, because we didn't notice this as a vote.
Yeah, okay.
On
All right,
the
we'll wait.
agenda,
That's
so we
fine.
might have to wait till the next meeting, if you wanna actually adopt them.
Yeah, okay.
okay, we
All
can
right.
put that on the agenda for next time, okay? So is there a motion for adjournment?
Move to adjourn.
And second, all in favor? Aye.
Second. Okay.
Aye.
God, 8:30, I can't believe that.
Thanks, everyone.